Repo market endgame finally revealed. I've uncovered some shocking insights that are going to blow you away. So make sure you're sitting down for this one. And I'm going to explain it to you in 3 simple, fast steps. Step number 1, the collateral issues that Jeff Snider has been talking about. Prior to 2009, the total amount of collateral in the system that was being injected and used for the repo market consisted of treasuries, but mostly mortgage-backed securities and other garbage like asset-backed securities and everyone's favorite oceanfront property in Arizona. The way it worked is the Fed was completely out of the loop. The primary dealers under the Fed's umbrella would go into the repo market, and the financial institutions and hedge funds would have this garbage collateral, and they would also have some treasuries. They would take that collateral, put it into the repo market, and the lending institutions would swap them, that collateral, for the cash that they needed. That's how it worked prior to 2009. Then the crash hit, and all of these entities that were lending into the repo market saw that this collateral was garbage. Additionally, their counterparty, such as Deutsche Bank, became riskier and riskier and riskier. So think about this from the standpoint of the lender. You've got the counterparty that you're lending to getting substantially riskier. You know that. And the collateral that used to be used, you don't want to touch with a 10-foot pole. You've got to assume that they're going to default, so the only thing that you're willing to take now are treasuries. So even though the total pie, the total amount of collateral available didn't change, the amount of collateral that was accepted by the lending institutions decreased dramatically. Although the government has been running trillion-dollar deficits, supplying a lot more treasuries to the market itself. The bottom line is we've still gone from 100% collateral being used in the repo market to about 50% collateral being used, although now we have a lot more treasuries. So the Fed steps in and injects all this cash that's needed in the repo market for those counterparties who are getting riskier and riskier, and they start to accept all of this garbage collateral that wasn't being accepted before. Why? Because they are an indiscriminate lender. They can't go bust. They don't have a profit and loss, so they don't care about counterparty risk, nor do they care about the quality of collateral. For this to be true, we would most likely have to see an increase of the amount of garbage collateral being used in the repo market once the Fed, or the indiscriminate lender, starts becoming a bigger and bigger part of that market. So has the amount of mortgage-backed securities being used in the repo market increased? Well, September through December, the percentage was 23%. In January, that percentage increased to 42%. The last 3 days the repo market has been open, the percentage has increased to 54%. And Friday, it increased to 78%. This shows us that the repo issues not only include counterparty risk, but as Jeff Snider pointed out, collateral. Step number 2, brand new insights. And for a lot of these housing insights, I need to thank my good buddy Jason at Wall Street for Main Street, editor. Throw up a picture of his channel. And guys, if you aren't watching his live streams, you need to start right away. We've got the Fed. We know they've kept interest rates artificially low to prop up the housing level. On the surface, it seems like they're doing that just to create more spending or the wealth effect. But as Jason points out, there's a lot more to this story once you start going down the rabbit hole. Prices of homes go up, but that means that the property taxes go up as well. We've got Harry, homeowner here, and this is his home. So if his property taxes go up, that means he's giving more of his hard-earned income to the local governments that take that additional tax revenue and put it into this massive gaping hole that they have in their pension funds. And let's remember that the portion of this pension that actually is funded is loaded with some fantastic companies like SoftBank, Uber, and most likely now HSBC, because I heard they increased their dividend. So they're only 50% funded, so they desperately need this additional tax revenue coming in from the local government, which is perfect because property taxes are increasing. Along comes Bill, the buyer, and Bill looks at this house and he says, wow, prices have been increasing. I have my recency bias all set in place. I want to buy your house because I like buying assets that are super, super expensive in hopes that they'll just get even more expensive. So he goes to the bank and gets himself a loan. And Harry, the homeowner, has got his thumbs up. He sells to Bill, the buyer. This does a few things. Number one, the Fed loves this because there's more money that's being created by the banking system and injected into the real economy. So let's think this through. If this house was $100,000, but because of all the Fed's financial chicanery, it's now worth $1 million. That's an additional $900,000 that's been created by the banking system, injected into the real economy to stoke the inflation that the Fed wants to produce to bail out the government and its $23 trillion in debt. Additionally, the federal government gets an extra $180,000 of capital gains tax from Harry because his house went from $100,000 to $1 million, while at the same time, the local government was getting an extra $9,000 a year because of the increase in property taxes. Oh, but wait, there is more. Jason outlines this beautifully on his live stream, but I'm going to take it a step further. I'm going to go deeper down that rabbit hole. The bank, instead of having a $100,000 mortgage, now has a $1 million mortgage. In other words, they have an additional $900,000 worth of mortgages. Well, what do? Of course, they flip it to Fannie and Freddie, and that goes from the real economy and goes right around this, comes dashing through the straightaway into the financial economy, where it becomes a mortgage-backed security. Mind you, it's a mortgage-backed security that's collateral for the repo market. And since it's gone from $100,000 to $1 million, that means there's an additional $900,000 worth of collateral for the repo market. Step number 3, the end game. The Fed has increased home prices by artificially lowering interest rates, which has put a temporary Band-Aid on the economy. It's increased tax revenue and it's temporary plugged, that massive gaping hole in the state pension funds. While at the same time, they've intentionally or inadvertently created more collateral that the financial institutions and the hedge funds can use to gamble and create bigger asset bubbles. Go Fed. They've also temporarily fixed the repo market by continuing to print money and expanding their balance sheet even further, and it's very important that you realize that. And because they're an indiscriminate lender taking all of this garbage collateral in the form of mortgage-backed securities. They're really transitioning into a new model that's very much like the Bank of England. And I say that because the Bank of England is their repo market. They don't do it like this, where the financial institutions and the hedge funds take collateral, pledge it into the repo market, and other private entities give them cash for that collateral. They are the repo market. So all the primary dealers or the financial institutions, hedge funds over on that side of the pond, they don't go into the market to transact with one another. Every single transaction is done by the Bank of England. So you say, well, that maybe could be a good idea. That would solve the collateral problem and the counterparty risk problem that we have in the US repo market. And all the Fed would have to do is continue to expand their balance sheet. Wow. Friend and family member Fred says they are geniuses. They have solved all of our problems, right? Not so fast. Let's look at a chart of the Fed's balance sheet. It starts in 2008, goes to 2020. When they start QE, their balance sheet, of course, goes through the roof. And it continues to go up through quantitative easing 2 and 3, and then starts to drop slightly when they reverse course and go into quantitative tightening. But now it's expanding again because of their interventions in the repo market. And this is a very big deal. Editor, throw up that chart of quantitative easing versus the yield on the 10-year Treasury. Every single time the Fed expands their balance sheet, interest rates on the 10-year go up. If there's a correlation between the Fed increasing their balance sheet and interest rates in the real economy going up, then we'd naturally see the opposite play out when they start quantitative tightening or reducing the size of their balance sheet. Editor, go ahead and throw up that more recent chart of 10-year interest rates. Notice what rates did when the Fed started QT and what happened to rates when the Fed reversed course and started to expand their balance sheet again to paper over the repo market blow up. It's obvious when the Fed increases their balance sheet, or BS, whichever you prefer, rates in the real economy actually go up. This is a huge problem. Going back to step number 2, when home prices went up, that had that trickle-down effect that actually saved, temporarily, the real economy. But if rates go up, home prices go down, tax revenue goes down, pension funds blow up, and the real economy comes collapsing in on itself. The problem is if the Fed doesn't increase their balance sheet, then the repo market blows up. They lose control over the short end of the yield curve, which does what? It has the exact same effect by collapsing the economy. The Fed has painted themselves into a corner where anything that they do will exacerbate the problem. The bond market has called the Fed's bluff, and this, in my opinion, is the end game. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.